Hope everyone's doing well today. I just wanted to send a video out and just let you know that I have a few minutes to talk about some of the recent developments in the financial world. More importantly, what's going on out in California with this Silicon Valley Bank and Signature Bank. And many of you all are probably a lot like me, is sitting there saying, hey, look, if it can happen to that bank, can it happen to my bank? What about my investments? What about maybe annuities or life insurance that we have with life insurance companies and different things like that? So I just thought I'd take a few minutes to put this video together and send it out to you all and address some of the concerns, talk a little bit about how this thing has come down and maybe some of the reasons for it. So, most of you, I'm sure, have heard about the banks in California that have been taken over by the federal government. The federal government supposedly over the weekend made a decision to go in there and make all the depositors whole, even those above the $250,000 FDIC amount. So in essence, it's a free roll for the bank, no matter if it was a situation that was caused by bad management among senior executives there, or whether it was an issue that was related to something else. But what I do know is some of the facts that have come out of it since then. Apparently, for some reason last week, there was if you want to call it a raid on the bank. What I've heard is there were somewhere in the neighborhood of about $42 billion worth of deposit holders that requested withdrawals. And when the bank went to cover those withdrawals, they started to go in and cash in treasuries that they had on the books. And again, these are numbers that I've heard through the grapevine, but somewhere those treasuries that were on the books were somewhere in the neighborhood of 80 to $100 billion in value. But those values were based upon the prime being at the 1% to 2% level that it was last year. And as many of you all well know, as interest rates go up, the value of bonds go down. So what happened is they started cashing these bonds in at a 4.5% prime rate, and they realized that they didn't have enough cover for the withdrawals. And thus the call to the federal government. I think it was a play to try to sell the bank, but it was maybe a little too late. And so the government decided over the weekend to take over the banks and to make all the deposit holders whole. Our loving federal government said that this is not a bailout, but knowing that the only way the federal government makes money is by taxing you and I, and then to use those taxpayer dollars to go in there and bail out people that were invested in a bank. And again, a lot of them may have been like you and me, but there were some investors in there that probably knew what was going on with the bank. I heard a news report this morning that said senior management supposedly sold quite a bit, if not all, of the senior bank managers' stock a couple of weeks ago. So there must have been some handwriting on the wall. And again, for us to go in and just start printing money and bail out people that maybe didn't deserve to be bailed out. I also hear that China has a large presence in this bank. So again, once again, the federal government gets to pick and choose who they take care of and who they don't. One of my readings through the years has been a book by G. Edward Griffin called The Creature from Jekyll Island. And it basically, I would encourage you to read it first of all, but it basically goes back to the early 1900s and the creation of the Federal Reserve, the creation of our income tax system, and how both the Federal Reserve and the income tax system has evolved through the years. And even going back into 60s and 70s, it talks about how the banks and the government have aligned themselves such that when banks get themselves in trouble, for lack of a better word, they can come to the federal government, and if it's severe enough and big enough, then the federal government can sit there and declare it a state of emergency, something that needs to be taken care of for the good of the people, for the good of the country, and basically bail the banks out, such that the banks are not holding bad notes. I wish you and I could run our households that way. I wish I could run my small business that way. But unfortunately, I've got to have more revenue coming in than what's going out, or I basically go out of business. But I also don't have that that printing machine down in the basement that apparently can crank out dollar after dollar after dollar. And again, this originated a couple of years ago with inflation. When inflation was at bay, the world was a better place, according to a lot of folks. And as the Fed has made it a point to try and tame inflation by raising the interest rates, this is some of the consequences of having banks with regulations and not having enough cover for deposit holders and the like. So that's pretty much what's going on with that. You know, some other things, if you look back to 2008, you would have thought we would have learned our lesson. But again, we've sort of got a repeat of that. And looking back to 2008 and sort of again reconfirming what the creature from Jekyll Island talks about, supposedly when the federal government at that time bailed out American General back in 2008, it was because American General had obligations from insurance claims to Goldman Sachs in the billions and billions of dollars, of saying if American General goes under, then the billions and billions of dollars of claims cannot be paid out to Goldman Sachs, and thus it puts Goldman Sachs in a precarious position. So the federal government decided to bail out American General, of which made Goldman Sachs benefit. But on the other side, you know, another one of these Friday to Sunday meetings basically said Lehman Brothers is not as important to them as maybe American General, Goldman Sachs, and we'll let Lehman Brothers go under. So again, the federal government is in a position of being affiliated with banks, and we can call it rubbing shoulders or taking care of each other or whatever the case may be. But whether it's GM or Chrysler or companies back in the 70s and 80s, we'll make it a crisis, we'll bail them out, and we'll let the American people, just like with everything that's gone on with COVID, bear the brunt of the price tag through taxes and the raising of our taxes. And we're currently under the 2017 Trump tax codes, which are due to last through the end of 2025. As many of you all have we've talked about in reviews, the current tax codes are for the most part low and fair. And again, if we have deferred taxable assets and we think taxes are going to be higher in the future, it may be prudent to be aggressive with paying those taxes while the rates are low versus down the road when they're higher. So these are things that we'll talk about and have conversations about, you know, throughout the year as we meet for our reviews and other things like that. Just a few quick slides that I put together on PowerPoint. Many of you can see the slideshow here, but, you know, is my money safe? And again, you know, what does safe mean? With the Silicon Valley Bank, it says in short, if you've got less than 250,000 in the account, then the FDIC is going to come in and help you out. Well, again, by the government stepping in, it helped out everybody above 250,000. Many of you all, you know, what does the word safe mean to you? And again, to each and every one of you, it means something different. In my opinion, safe means little or no risk. And a lot of you all have got some or part of your portfolios by design in those types of investments, whether it be some of the structured buffered investments that give you downside protections in your investment accounts, whether it be in the fixed index annuities, which basically has a 0% return if an investment is in the negative, as being a worst case scenario. Those are some of the ways that we go about hedging against risk and having more safety. And when we look at that, you know, the insurance regulations are different than bank regulations. it mentions a joint statement here that happened from Yellen and Jay Powell and the FDIC chairman, Martin Gruenberg, about, again, the FDC making all of Silicon Valley and Signature Bank's customers whole. So again, even if they had above the 250,000 threshold, they're going to take care of them. And while this is good for those deposit holders, again, are we bailing out people that knew what the situation was and took advantage of it? And maybe because of affiliations, maybe because of rubbing shoulders with the right people, the reason to take care of this is happening. I don't know. But sometimes I wonder if, ABC Bank here in Louisville, Kentucky had the same issues going on, if they would be as willing to come bail that bank out as they are with the ones out in Silicon Valley. I don't know. I don't know the answer to that. It's the largest bank failure since 2008. It basically lies in the rising interest rate environment, which has been going on for the last couple of years because of rising inflation that was sort of initiated when they started cutting back on energy production in the U.S. and basically lending that out to other countries, while we decided to go down a path of electric cars and windmills and different things of that, batteries and all the like. And again, I'm not sitting here saying that's good, bad, or ugly, but I do wish we would take a position of a government and say, if you want to drive an electric car, drive one. If you want to drive a SUV that's gas powered, drive one. Let the consumer, let the American person be the one that judges how they want to live their life. Apparently our government decides that maybe they want to be a little more involved in that. I don't know. Again, 89% of the bank's deposits at Silicon Valley were above the $250,000 threshold. So again, under normal circumstances, they would have lost that and they would have got their 250 from the FDIC and they would have gone on down the road, much like what happened to Lehman Brothers in 2008. But again, that is not the case that's happening. In the country, currently, there are 5 times more banks than there are insurance companies. A lot of people may be sitting there saying, Tony, what about my investments? What about my insurance products? Are they safe? And that's, again, one of the reasons I want to have these few minutes today to have this conversation, share this video with you. So again, there's 5 times as many banks in this country as insurance. But again, since 2008, there have been 512 bank and savings and loan failures versus only 20 insurance company failures. So why is that? Is it because the banks are backed up by a government that's $31 trillion in debt? Possibly. The insurance companies, which are listed here, and you might, just browse down that list, you'll notice that not many of them are household names. I don't really recognize any of them myself. But the insurance industry acts in its own self-regulating way. So anytime an insurance company does business in a state, part of the requirements for that company to be able to do business in each and every individual state is it must adhere to paying money into the state's guarantee fund. And each state has its own guarantee fund. And what that basically means, it's a safety net. So what happens is that any of those 20 companies on the previous page goes under, those policyholders have valuable contracts that other bigger and larger insurance companies may come in and buy out on cents on the dollars. And then whatever that gap that is left, the guarantee fund will step in. So for instance, in the case of annuity benefits, the safety net in the majority of states is an additional $250,000 of coverage under the guarantee provision. So if a larger insurance company comes in, buys up those assets for cents on the dollars, then you've got that amount of money that is now in play for you. And then the guarantee fund comes in and pays an additional up to $250,000. And in other states, that coverage may go up to as much as $500,000. And that's on annuity benefits. For life insurance benefits, on the life insurance cash value, in many states, it's up to $100,000, but in some other states, it can go up to as much as $500,000 for the cash value protection. And again, that same 300,000 to 500,000 for the actual life insurance protection. So again, the insurance companies, which have to run their business, much like your household and my business, by making sure the assets are always greater than the liabilities, self-insure themselves to a certain extent by saying, hey, look, there is value in those policies that lay in a company that might be having financial trouble. And then we take the guarantee funds above and beyond that to make sure that our policyholders become whole. Whereas again, the banks have to rely on the good faith and efforts of a United States government that's over $31 trillion in debt. So again, insurance companies take care of themselves. And this is one of the things that I wanted to share with you today, so that if you were having some uneasiness about your underlying investments or underlying annuity or life insurance contracts, hopefully this gives you some ease. What are the investment risk and options? Again, we've got structured contracts out there that's got 100% protection in risk and the ability to still be indexed to the market. So the S&P 500 return, the Dow return, the NASDAQ return, we can be indexed to those different types of returns for a 12, 24, 18-month period. And if for some reason we have a repeat of 2022, where let's say the S&P is down 20 to 25%, guess what? When it's time for that contract to mature, you just simply get 100% of your principal back. So again, being able to invest in the market while having underlying 100% risk protection are things that are out there that we can participate in. The fixed index annuity contracts, even if the index that you're aligned with has a negative return, you just simply get a 0% return. So again, sometimes those pieces give us the diversification to know, even in the 2022s, the 2008s of the years that we go through, or even these things that we're looking at over the past couple of weeks with the banks, we know that we've got the position to be well diversified and to work through it. So even one of our third-party money managers had to make a very difficult decisions about one of their investment banks that they looked at in early 2022 and said, this company looks good. But over the last 18 months, again, due to those rising interest rates, they had to come in and make a judgment last week of saying, we need to liquidate these funds and these different strategies with this particular investment bank because we don't feel comfortable with them right now. So again, there's a fiduciary being able to take care of you as best as we can, even if sometimes it might hurt a little bit, much like what the markets did last year, you know, when we didn't have some of those safety nets under some of the managed money accounts. So I just wanted to share this information with you. Again, many of you all, we've got scheduled reviews coming up and we can discuss a lot of these matters at that time. I would hear you, if you don't have a scheduled review already on the books, to call the office at 502-632-3340, you know, extension 102 for Chastity, to get you on my calendar. And make sure that if you're coming in and you've got, you know, 401k, IRA monies, you basically say, Tony, maybe we need to get a little more aggressive with the tax over the next 3 years because of the tax rates being, you know, at all-time lows, and with the possibilities that starting in 2026, they could start increasing. I've heard rumor that they might go back to the 2000 tax rates, which are basically 30% higher than what our current rates are. So again, these are things that we always want to look at, talk about, and have conversations about, even if we don't do anything, but want to reassure you. So again, thank you so much for being our clients. We love each and every one of you. We love working with you. Take a few minutes, absorb what I've talked about here today. And if you have any more questions, please get with us here at the office, and we'll have some additional discussion. Again, have a great rest of your week. Stay safe, and if there's anything at all we can do for you, feel free to give us a call anytime. So again, thank you, and we'll see you later. Bye-bye.